Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was April 2026. And yes, we're a couple days late with this, but there was this thing called the budget that threw a bit of a spanner in the works. Let's talk about what's happening in the market last month with the lagging data that we have, and then let's talk about the changes that have happened within the last 2 weeks. First of all, looking at the data for the index results as of the 30th of April, we can see that Perth performed the best at 2.1% up for the month. Again, just amazing numbers. Darwin trailing at second place at 1.3, followed by Brisbane at 1.2. Median dwelling value across the combined capitals still over $1 million, just creeping up at $1,031,838. Let's have a look now at what we're doing in regards to the speed of the market. So what we can see here in alphabetical order, Adelaide faster than what it was the month before, up $2,200 per week. Brisbane also faster, up $4,200, followed by Melbourne, which was actually slower again than it was the month before. Now Melbourne's traveling at about $300 per week. Perth, again, just like a bat out of hell, up $5,200 per week. And then Sydney, slower than what it was the month before, up $1,000 per week. Looking at more of the mid to long-term data here, we've got the 5 years and 10 years showing over the last 5 years, Perth's had the best performance at 92%, followed by Brisbane at 84%, and then Adelaide at 77.4%. You can see at the bottom there that across the combined capitals, the average performance has been about 33.7%. So when I see Melbourne over the last 5 years only performing at 5.8, and then also over the last 10 years compared to 69.3, only performing at 36.9, I just think there's a lot of opportunity there. Obviously, you need to be careful as to where you're buying and what you're buying specifically. But what I'm saying from a probability perspective, if we look at Melbourne's performance for the 30 years prior to COVID, it was the best performing capital city in Australia. So the question's going to be, has the Andrews government and the Allen government totally changed the Melbourne market now and forever? Or are the dominant forces going to bring the market back into alignment with its true performance, considering it is the most populated city in the country? Food for thought. Okay, now if we look over the last 10 years, best performer, Brisbane, 119.5, Adelaide, 111.4, and Perth, 107.5%. Looking at dwelling approvals, and this is obviously a big thing that they're talking about now, considering the big part of this budget was all about creating more property and making it easier for everyone else, whereas the budget document actually reads that they'll probably have about 35,000 less properties per year than what they originally thought they would have. Australia has recorded only about 196,491 dwelling approvals over the last 12 months, and that's still below the 240,000 annual target that they're supposed to have every year for us here in Australia. So at the end of the day, I can't see this number getting any better. This is also actually the big reason for me why I can't see a significant market correction. When I say significant, I mean over 10%. I can't see that because we don't have the supply to create a buyer's market. It just doesn't work like that. So I think that's quite interesting. Here, just having a look at the total listings, we can see listings have actually dropped a little bit. So people have pulled listings. I don't think that's because they've been purchased. I think that's because they've been pulled. So we've actually dropped from about 15% the month before when I did these numbers to 9.6. So that's a pretty big drop. And then we can also see across the capital cities there, again, Perth was over nearly 30% less stock than what it had the year before, and now it's only 14.7. So I think there's less people willing to pull the trigger on selling those properties. They've taken them off the market. But those softer markets you can still see, like Sydney and Melbourne, where there's actually more stock available today than what it was this time last year. And again, that oversupply is definitely making property prices a little bit weaker. From a rental yield perspective, and I think this is an interesting indicator, what we can see here is we can see that Sydney is still the lowest, followed by Brisbane in second place, And then we've got Adelaide in third place. We've got Perth in fourth place. But now in fifth place, we've got Melbourne. So Melbourne actually now has the highest rental yield out of the major capital cities. So I do not count Canberra, Darwin, or Hobart as a major capital city. But right now, out of the majors, Melbourne's giving us the highest rental yield at 3.8%. You'll remember during 2022, when they started increasing the interest rates, and we had 13 rate rises, places that had the best growth during that time were the ones that gave you the best rental yield, and that was Perth and Adelaide. Now it's Melbourne. Will that growth go there? I'm not sure, but definitely it's an attractive worm on the line. Okay, let's have a quick look now and talk about the budget. I might actually just need a drink. I should have poured one before I started. So the rules have changed, and I want to explain them to you, okay, in the best detail that I can. And please, a quick caveat. There's so many articles about this government's budget and how they've changed. I'm telling you what it is as of today. It doesn't mean it can't change, okay? So don't take any of this as financial advice. But at 7:30 p.m. Australian Eastern Standard Time on the 12th of May, 2025, the budget was introduced by Jim Chalmers, who just looks like he needs a hug, that bloke. And basically what ended up happening is that they took away negative gearing, okay, for any property purchased after 7:30 on the 12th of May. They grandfathered it for people that had properties prior to that were taking advantage of negative gearing. They have said that there's a grace period up until the 1st of July 2027, where if you buy a property that is under the new regime, you can still take advantage of negative gearing until the 1st of July. So yay, you get 15 months of negative gearing before it's pulled out from under the rug and you've got to figure out if you can actually afford the property anymore. Then what they also did is that they updated the CGT rules. So we'll talk about that in a moment. As of the 1st of July as well, there's a 30% tax, minimum tax on trusts as well. So there's a few things here. So let's look at it. Scenario one, if you already own an investment property, so you owned or contracted before 7:30 p.m. on that day, negative gearing is fully grandfathered. We got a few clients across the line on that day. I could not believe it. We were so happy for those people. The CGT discount, 50% on gains. That's until 2027, so July. So that means that currently at the moment, you've got a 50% discount on the gains that you make on any property that you sell, which means as this approaches closer to July 2027, we're going to see people having to make that decision of, do we sell now and lock in the fact that we only are going to pay 50% of these net profits, or do we wait for this new indexation system to come in? By the way, when I say new, this is not a new system. This is an old system that they used in the 90s, and they actually discontinued it because it was so complicated and it just wasn't working properly. So, hey, let's re-bring that back in. Isn't that interesting? From the 1st of July, new indexation on future gains only. That will happen. So for us, if you own property, don't sell it. I mean, at the moment, you've got something that is truly blessed. It is something that is unique now. They're not making it anymore, okay? They're not making negative gearing anymore. So if you've got it, hold on to it because it's something that you can take advantage of. Scenario two, so not if you already own, but if you're actually buying an established property now, okay? So if you're purchasing an existing residential property after the budget night, the CGT, it works normal, okay? From a negative gearing perspective, it's going to work normally until June 30, 2027 in regards to negative gearing. From 1 July, you're not going to get any new tax breaks until the property itself actually turns a profit. So once the property is positively geared, then you can offset the losses that you took in the years that it took you to get the property positively geared, okay? That's the big win there. So your losses are actually banked. They're not lost. So what they're saying is, oh no, we're not actually... There's no change for you. All it means is instead of you taking advantage of the tax breaks here and now, you're going to roll those losses, and then when you go to sell it, we'll calculate it, and then you'll end up getting a better profit basically at the end of the day instead of taking advantage of that during the period of holding on to the asset, which Still doesn't really make a lot of sense to me, because at the end of the day, it just means you've got to have a higher cash flow to manage that and hold on to that for longer. Negative gearing was simply this to me. It was a way for you to hold on to an asset for longer, knowing that it's not going to make you money for a while. It was a long-term play. And the carrot there was, as an investor, you are going to buy a property. You're going to risk your money, not the government's. You're risking your money, and you're going to house an Australian family that needs a home to live in. So you're also going to pay rental management fees, insurance costs, maybe strata, there's maintenance. But you're hoping that that property is going to go up in value. And because you're going to take those losses and continue housing that family, we're going to give you some tax back. Okay? We're not giving you a massive break. All we're saying is that the tax that you would have paid on your income will take off the amount that you're actually paying, that you're actually taking as a loss. All right? That's what we're going to do. It was nothing that amazing, right? It was nothing that was greedy. It was just the way to run a business. And they've taken that away. And it does frustrate me a lot, because as a father of two little girls, one day I was expecting that my girls would take advantage of negative gearing. They'd keep living with their dad, and I would get them to buy a property. I'd let them live with me. And while that property's starting to make them some money, by the time, a man's unlucky enough to marry them, then what will end up happening is they've created a foundation of wealth for themselves, and them and their husbands can figure out, what are we going to do next? Okay? And it'll just put them in a better position. Also, it takes pressure off the government to help my children later on in life. Because by the time my kids get to a stage where they go to retire, they can go to the government and say, I don't need your pension. I have created my own wealth. Thank you very much. Use that money to help those people that couldn't help themselves like I can. That's the Australian way. But instead, the government's gone, no, we want you to fully require all of our assistance for the rest of your life. Be more dependent. That's the good way. That's what upsets me about this. This is a great country, and this is a really stupid decision. I shouldn't be emotional about this. I should just be going through the data. So I'll just keep trying to. Please forgive me. Okay. So the key actions is you've got to review borrowing capacity, because now the calculations were based on negative gearing, and you're not going to get that after the 15 months from when this was announced. So you need to make sure that you're in a position where you can continue to hold on to that property without the negative gearing. Now we can see here, scenario 3 is buying a new build. And this is the solution. This is the grand solution from the Australian government, is we want to encourage new properties to be built because we haven't been able to build enough for ourselves. So what we want you to do is we want to restrict you from an investment perspective to say you can only buy new build properties. Okay? And the new builds will have fully retained their negative gearing benefits against your wages. And, you can still have the 50% CGT exemption if you like, or you can actually have the indexation. So they're giving you a choice here. You can choose. Unlike with established purchases where they're just going to say you have to do the indexation model. So they're really trying to make new builds very attractive. So it's really going to have no impact in any way on people that are purchasing new. And there's nothing wrong with new, okay? Providence has purchased hundreds of new properties over the years for our clients. I own some new properties that I bought for myself off the plan and have built. They can be really good. The problem is that there's limited choice. A lot of new builds are in locations that we wouldn't want to buy in the first place. So you want low density. You want something that's boutique. You want something that's in an established location. They're the properties that you want. The catch, you're going to pay a premium for it. What's the issue with the premium? Well, the more you pay for it, the longer it takes for the property to really become positive in any way. But you've got negative gearing, so you can take advantage of that for as long as you want, basically, to minimize the holding cost of the asset. This is one of the reasons why new builds do make sense now from these changes from the government. Okay, now we're just going to have a quick look at some of the scenarios. Okay, so a mum and dad investor buying an established property, what's going to change for them? From July 27, negative gearing losses can only offset rental income, not wages. So losses can be carried forward. That means until the property is positively geared itself, you're not offsetting anything. Why you should consider an alternative? Well, the tax benefits of negative gearing is reduced, and that's going to impact the cash flow. So that's maybe why you should potentially look at new builds, higher yielding property, dual income product, and potentially you might delay your purchase and save a larger deposit. If you're a mum and dad investor that's looking to buy a new property, negative gearing is definitely more favorable on those new builds. The CGT choice of 50% or the indexation is good, and you got a 30% minimum tax rate on trusts. So new builds are more attractive in that respect, tax-wise, but they carry build risk, delays, and yields trade-off. So there are some risks going to be involved. But again, at the end of the day, it's just about what makes the most sense for you and your personal risk tolerance level. Then you've got the alternatives to explore. So mum and dads, look at off-the-plan apartments because they're going to give you a higher rental yield. Again, please try and make sure they're in low density blocks, something boutique. I don't want anything that really has gymnasiums, pools, underground car park, basement level, all that type of stuff. It just eats up strata. Okay, and if you're not going to live in it, why do you need to pay for it? Okay, they're usually also a bit smaller, and they're in outer markets, so they're a little bit further away. I'm not going to go into each one of these. I'm actually going to give everybody the image here so you can review in your own time and check that all out. So what constitutes a new build? This is really important. So a new off-the-plan apartment, a knockdown rebuild duplex, replacing a freestanding home. So you can knock down a property, but you can't just rebuild it. That doesn't make it brand new. You've got to rebuild two properties on there, or a duplex. Any residential construction on vacant land. So if the land's been vacant and you build today, then that means it's a new build, or a newly built property occupied for less than 12 months before the first sale. Now, what does not qualify? A house built after knocking down a smaller house, a granny flat built next to an established home, which upset me. I was hoping we could keep that. A newly built property occupied over 12 months before sale to a subsequent investor. And then lastly, adding bedrooms to a property. That, increasing the amount of rooms does not make it brand new. So what should you do? If you already own an investment property, you're in a good position. Okay, you're in a good position because it's been grandfathered. There's not much that you need to do in that respect. The 2026 budget restricts negative gearing on new purchases of existing homes, but any property you owned before the 12th of May is grandfathered. So you're in a good position. For future purchases, the type of property matters enormously now, what you are going to buy. Okay, and at the end of the day, new builds are definitely offering those benefits from a negative gearing perspective, which means long-term holding costs are going to be lower. The depreciation is going to benefit you. But do not count out established properties. There's going to be a rush for developers and private builders to purchase property on decent sized blocks, knock them down, do duplexes, triplexes, townhouses, etc. Which means if you've got a property in a good location, or you buy a property in a good location with a decent sized block on it, this is going to become attractive from from a development site. So that's going to make it a hotter commodity. So I think that's really important. Lastly, you got to seek advice. If you've got a self-managed super fund, awesome. That is not being affected very much. You're only in a 15% tax bracket anyway. So take advantage of that. If you don't have an SMSF, look into it. Is it worth it for you? Do you have enough money saved in there? Okay. You can also talk to your accountant about trusts and other things. We're not going to go into that on this channel because we don't give advice on anything like that. But definitely those are some of the things you should look at. The last thing I just want to show you is the true actual effects of this. So I put together a holding cost model with the median house price, the median unit price, and the median dwelling value across the combined capitals and their respective rental yields. I assumed a 6.5% interest rate. I assumed a tax bracket at the top level at 47%, 47 cents on the dollar, and also 100% borrow, so a full equity redraw. These were my what the models included, so you can pause this and review these, but this is what I used. And this is the actual cost breakdown. So from a house perspective, you can see the net shortfall for negative gearing is $47,000, but you actually get money back on that 47 cents on the dollar tax bracket. So it's actually better off by $22,000 when you're taking advantage of the negative gearing for houses. For units, $12,500, and for the average dwelling, about $20,000. So you're worse off without negative gearing by about $25K on houses, $14,000 on units, and $22,000 on regular dwellings. That's the change here. Weekly, the shortfall, the difference is a $923 shortfall, and then that's with no negative gearing. Okay, with negative gearing, the shortfall was only $489. In a unit, $513 without negative gearing, and with negative gearing, the shortfall would only be $272. So these are significant changes to the holding costs of an asset, and these are the things that we're going to have to look at to make sure the client, you as a client, are in a better position. So that's pretty much it. I'm not going to go into this in any more detail. To be honest, it's just depressing me. The last thing I just wanted to show is over the past 40 years, Australia's combined capital city housing market has navigated 10 downturns. Okay. And although there may be a downturn that could potentially come from this, you've got to look at, well, what would that downturn potentially look like? And if we look at this data, over the past 40 years, Australia's capital cities have navigated 10 downturns where home values fell over at least a 3-month period. And the most significant decline was 2017 to 2019, when values fell by 8.2%. So I'm not saying over that period of time they were down 8.2%, but during that time there was a period where it was down 8.2%. It could have rallied, but this chart is just going to show you the downfall side of those things. 8.2% during that time. The next one was year 22 to 23, and that was most likely triggered from when the RBA said we're not going to touch interest rates, and then they hit us with 13 rate rises from May 2022 into 2023, and that saw a drop about 8.1% over a 9-month period. Again, we ended the year in positive territory, but that was the drop. So what I'm saying is I'm not too stressed about this market dropping. Even if it does, I think this is going to be simultaneously the best time to negotiate for pricing and get a great price on a property for yourselves. So if there's anything we can assist with, please let us know. Thank you so much for your time, and we'll keep you up to date as changes come in with this budget. God help us all.